Good afternoon and welcome to this week's Tax Tuesday. We are glad you are here. Once again, I am Clark Boyd with Mullen Associates, and today I'm joined by Kathy Stump, our accounting and tax manager. Today we want to talk mainly about education credits and student tax benefits around. So we're going to talk about the American Opportunity Credit, the Lifetime Learning Credit, 529s, and even how the One Big Beautiful Bill has changed the education benefits. Education for most families is a very, very large expense. So you've got retirement is probably your number one planning opportunity, but education is probably number two right behind it. So it's also one of the most confusing parts of the tax code, or at least one of the most misunderstood. So our goal today is not to help you memorize the rules. It really is to help you understand what benefits exist and how and which ones apply to your situation. That way you can avoid missing credits, avoid missing or making costly mistakes. So it's really about clarity, not basically avoiding complexity. So as always, feel free to put any questions you've got in the chat. There's a little question mark. If you hover towards the bottom of your screen, you can add any chat. You can chat with our Q&A. We'll answer any as we go, and then at the end, we'll open up for Q&A. Even if it's not related to the education credits, anything like that, we're still happy to answer your questions. So let's jump in. So Mullen & Associates, we are a tax and accounting firm. We've been in business serving self-employed individuals, small business owners, and individual taxpayers since 1980. So we've been doing this a long, long time. We've seen lots of changes to the tax code. We've seen lots of different situations, what works well and also what doesn't work well, which gives us a unique opportunity to teach taxpayers what they can do in their situation to improve not only their tax situation, but their financial position as well. The educational tax credits and deductions aren't really confusing in and of themselves, but it's really confusing because there's not just one rule or program. There's multiple credits, different income limits, different definitions of what qualified expenses are, how you coordinate that. So that's really what brings the complexity. So we want to take all of that complexity, water it down into something very clear and simple so you can at least understand what you should be able to take advantage of. A lot of people assume if I paid tuition, I get a credit, or I have a 529, I'm covered. It's not that simple. Educational benefits don't stack automatically. So that coordination matters more than just your contribution. Going over some of the big picture here, we're going to talk about three different benefits. So number one is credits, and these reduce your taxes dollar for dollar. So if you think about, I earned $100,000 of income, and let's say you have $50,000 of expenses, you have $50,000 of profit in a business would be the situation. You'd owe taxes on that $50,000 of profit. So let's call it $10,000 of tax. A credit would reduce that $1,000 of tax dollar for dollar. If you get child tax credit, it's not offsetting your income, it actually offsets the taxes owed. Whereas a deduction reduces your taxable income. So think of it as if you make $100,000 and you have a $6,000 senior tax deduction, your income is now $94,000. The one other bucket that these tax benefits fall into is tax advantage savings. So this is like a 529 plan. Or think about traditional IRA or Roth IRA. These are tax savings accounts. They have better tax treatment than you would if you just put it in a brokerage account or a savings account. So we're going to cover all three of these in different ways. Kathy, do you want to kick us off by starting on the American Opportunity Credit?
Sure. As Clark mentioned, this is one of the items that is a credit. It has some limitations, though. It is only available for the first 4 years of the child being in school. So if they go on to a master's program or doctorate program, this credit would be phased out. It's also available for, it can't be just, we used to call them like professional students. If you're going to school without a clear plan on what you're going to do, you have to be pursuing a degree and be enrolled at least half time. And that will be one of the boxes that will be checked by the school when they send out your 1098-T. But what's on that is qualified expenses include tuition to the school, of course, Sometimes there's fees involved at the school. Just some have enrollment fees, some have lab fees, some have computer fees. Any of those kind of fees that are required for the school are included as well. And also required books or supplies. And this is what people sometimes miss because these can be paid outside of it's not paid directly by the school. So it's not very often reported on your 1098-T. You need to keep up with these items separately and how you paid for them. Paying tuition alone, as Clark mentioned, doesn't necessarily always guarantee eligibility. That's why you have to make sure that you're going through all of these other requirements, making sure that you're pursuing a degree, enrolled at least half time, and that you're only claiming it 4 times per student. And there are income limits as well for these credits. They start single at $80,000 of AGI, and up to $160,000 for married filing jointly. There are a short phase out window, about $10,000 of 80 to 90 on single, and about $20,000, 160 to 180 on married filing jointly. There are some add backs and foreign income exclusions to get to what they call MAGI, which is modified adjusted gross income, but those are fairly uncommon. And this is a lifetime learning credit. And this one kind of takes the place of when you get to a situation where your child has possibly gone on, taken a little bit longer to graduate, or maybe went on to a master's program, or decided that traditional college wasn't for them and had joined a trade school. These are non-refundable. That means you can't get a refund more than you would have paid in tax. They do have lower income limits than American Opportunity Credit, and you can only take 1 credit per return. This is one of those things where you always have to realize that you can't really double dip on these. The IRS is tracking these. The American Opportunity Credit is usually better than the Lifetime Learning Credit, but the Lifetime Learning Credit can last a longer period of time, and it covers some things that would not be covered, like trade schools and those kind of things that would not be covered under the American Opportunity Credit. This is the double dipping rule that we talked about. You can't use the same expense for 2 different credits. Example of that would be if you paid tuition to your college, and then you decided that for part of the year you qualified for American Opportunity Credit, but then you also thought it qualified for Lifetime Learning Credit. You can't take those against the 2 credits. And it also cannot use the same expenses to make a tax-free 529 withdrawal, because the rules for 529 withdrawals are that you can deduct or take out whatever you put into the plan, but you can also take out earnings and profit over the time that they've had the plan open, but only if they're used for qualified education expenses. So basically every dollar can only be used once.
So what is the best way to track that? Because you mentioned on the 1098-T, you'll figure out what the expenses were for the college tuition. You got your 529, so you know the disbursements there. How do you track to make sure you're not double dipping?
Basically, it always starts with tuition, and that is recorded on your 1098-T. And the other thing that people sometimes miss on that is if your child is getting scholarships, that reduces the qualified tuition expense. So, if example, you had a $20,000 tuition expense, but of that your child had earned a $10,000 scholarship. So your qualified education expenses in that situation would only be $10,000. And if you took that money out of a 529, and just for example, say you took out $6,000 from the 529, you would only have $4,000 available. Then that would be toward the other expenses for the kids. Possibly one thing that people forget about is books and those kind of things, like I mentioned before, that people don't. It's not on any form. So you have to keep up with those individually, just kind of like you would any other expense, keep up with receipts, kind of the proof of what it's used for. So that if you're ever audited, that you would have that proof of, okay, I bought a computer, I bought these books that were required by the school, those kind of things. Also keeping a log or a kind of your receipt from the school would show, usually if you're buying your books from the bookstore, it'll have a receipt that'll show this is required for class ABC. And that way you'd know that they were required by the school.
Great. So that covers the 2 credits we were talking about. Dipping into how to save for college, 529s is probably the most common. There's other ones, it's not the only one, but it's probably the most common. A 529 is a tax advantage education savings account. So the reason we like them is it's tax-free growth. You don't get a deduction when you put the money in, but you get to allow it to grow tax-free. So if you're investing, let's call it $1,000, $2,000, even a year when your kids are young, that can have pretty serious compounding effects by the time they're 18, 19, 20, going through college. The other nice thing is the tax, you basically on qualified expenses, like Kathy mentioned, you get tax-free withdrawals. There's also certain different state conformity. Every state's a little bit different when it comes to this, but there's possible state tax benefits. So it's really good for broad educational use. As far as, here we go, I did put a slide on this. For what is qualified versus what is not. So college and grad school tuition and fees, room and board, book supplies, required technology, even K through 12, you can do up to $10,000 per year of that. Trade schools, certifications, apprenticeships, even some student loans. Some may qualify for repayment there. The One Big Beautiful Bill, it expanded the use for 529s. Before it was pretty strict, really just college. So they've expanded it to now K through 12 has a much broader ability to use that, as well as postgraduate or trade school. There's a lot more uses there. A couple common 529 mistakes, and Kathy kind of alluded to this. So if you're paying on non-qualified expenses, let's say travel to and from home, if your student lives out of state, that travel is not an educational expense, it is not required. If you're paying for rent above the school limits, that also does not qualify. Transportation, even if they live off campus and they need a car or they need a bus pass, that type of transportation insurance is not a qualified educational expense. And Kathy talked about double dipping. That's a big no-no. That's really just the tax code in general. You don't want to double dip. Every dollar has a dedicated use. But another thing to mention is poor documentation. So that's only important if you're really audited, but it's easier to create the documentation now than if you're ever in an audit, you're not going to be able to put the documentation together. So Kathy, what would you say is the best way to document, basically to make sure you have everything in order if you are audited, let's say 2-3 years down the road?
And like you said, the odds of being able to go back and recreate it are probably not very good. So just anytime, do like you would any other bill, keep either a digital log or a file, just a file folder that this is my tuition expense. A lot of times you can track that on the school's website. You can see what in your child's account. You can see that they billed for the first quarter on this date, and it'll show your payment. So that's a good record. If you're paying directly, like with a check or a credit card, then obviously keep those receipts and those canceled checks. Anything that you pay outside, like if your child is living off campus and you're paying rent, you'll want to keep 2 things in that situation. You'd want to keep the like check or however you were paying the rent to prove how much you did pay. But you'd also want to prove that what you paid was not above the school allowance, because you can't let them go out and, have a $10,000 a month apartment or a condo when the school allowance is only $1,000. So that's a common mistake. And like we mentioned, transportation, insurance, those kind of things, health insurance, those kind of things are not education expenses. The documentation for other type of like additional books, computer equipment's the common one. Anything that you are required to buy, like sometimes there's additional lab fees for a certain class. There's additional computer expenses per certain classes. You just need to make sure if you're using the school's account, you're using whatever the school, like the login, and you're showing that all that stuff's included. That if you have to write an additional check sometimes for a lab fee or something like that, that you keep up with that in addition to what you've got in their account.
Perfect. Beyond 529s, like I said, there's a few other options. Roth IRAs is a good one. Pretty recently, they expanded Roth IRAs to be able to be used for education expenses. You've got Coverdell ESAs, UTMA accounts, even Trump accounts have some use here. So let's dig into each of these. We're going to go pretty rapid fire through some of these. If you have any questions on them, feel free to put them in the chat. We can even stay around for some Q&A afterwards. But I just want to cover these as options for use. So the first one here is a Roth IRA. So a Roth IRA is a retirement account. So that should be its first and foremost primary use. But contributions, so if you're putting in $6,000 a year, that initial contribution can be taken out tax-free. And even the earnings may be penalty-free for education. So that gives you a lot of flexibility, especially if you're a business owner and you're paying your children as an employee of your business. You can take your higher income tax rate, pass it down to their lower income tax rate. They can invest into a Roth IRA and fund their own education through a Roth IRA. So that could be a really good tax planning strategy for you. I would not probably use a Roth IRA as your primary source of funding college. It's a good backup plan. It's a good flexibility insurance, unless you have work with your financial planner, figure all that out. But it is a good plan. There are contribution limits. If you're over a certain threshold, you do phase out of being able to contribute to a Roth IRA, so you have to do a backdoor. This also, if you take money out of your Roth IRA, obviously that reduces your long-term retirement savings. So that is a downside. For Coverdell, the next one here, so this is an education-only account. And I'd say probably the biggest con to a Coverdell is you can only do $2,000 per year of contribution. It is, like I said, it's education only. The tax-free growth can be used for qualified expenses. You can use it for K-12, higher education. There is a phase-out range for married filing joint of $190,000 to $220,000, and the funds must be used by age 30. So it's a lot less flexible, but it could be a good way to supplement if you want to do this. For custodial accounts, this one is another good asset that you can use. It does not have to be used exclusive for education. It really can be used for anything. The important thing to note here is the assets legally belong to the children, not the adults. So they have the ability to do whatever they want with them. If you're also looking at FAFSA, Pell Grants, or financial aid type situations, this is an asset of the child, not the parent. So it's kind of more of a strike against them because they have more funds in the account. So that's a good note to remember on the UTMA and UGMA accounts. Trump accounts are a newer one. This isn't designed specifically for education, but it's a good way to seed fund children for long-term savings. So it can support education, workforce training. There is restricted use. These are still pretty new, so there's not a lot of documentation on what it can and cannot be used for, but this could be a great way to supplement and save for long-term education. So if you're going to compare them, I'd say 529 is probably the best core educational topic. Roth IRA is a great backstop. There's some other tax planning opportunities that you can use with it. Coverdell is a great K through 12 option. Like I said, smaller contribution limits, whereas 529 doesn't have those same limitations, but it's a great way to save a couple $1,000s here and there. Custodial accounts have more flexibility, but there's less control. And then Trump accounts are good supplemental kind of starter funds. Anything else you'd add on those, Kathy?
I don't think so. I think considering the child's savings accounts, those things, if you're like sometimes the grandparents will set those up for them and not realize that at the, when they turn 18, they do have legal control over them. So you don't, the grandparents or whoever set those up for them might want them to be used for education, but it's beyond your control. After they're 18, they can, withdraw it and do whatever with it. So it's important to always keep that in mind and make sure other people contributing to those accounts realize that.
Yeah, perfect. So we put together this slide. It's got on this left-hand column over here, it's got the different features of the different accounts, and along the top it has the 5 accounts we talked about today: the 529, the Coverdell, the UTMA, Trump accounts, and Roth IRA. So this could be a good resource for you if you're looking at kind of comparing and contrasting the differences. But really, that's all the content we've got planned for you for today. So we'll move on to our Q&A section. So feel free to add any questions you've got to the chat, and we'll get to them. Starting with the first question here. If I'm above the income phase-out limit for the AOC or the LLC, the 2 different educational credits we talked about, can my child take the credit instead of me?
In limited situations, they possibly could. They're not just across the board prohibited from taking it, but where you run afoul of the rules is that they have to claim themselves. They have to have a tax return, and they have to be claiming themselves as a dependent. So in other words, they cannot be claimed by their parents instead of themselves, which is common with, college age students have just a part-time job that's just a supplemental thing. But the problem with it is to be able to take the credits, they have to have that dependency exemption claimed on their own return. And the rules for that are that they have to be able to be proving that they're providing more than half of their own support, which is really the stumbling block to being able to do that on a child's tax return. Usually their income is just from a part-time job or something like that wouldn't show that they could fund at least half of their living expenses.
Perfect. If I want to avoid double dipping, can I use personal funds for the American Opportunity Credit and 529s for the rest?
You could do that, but you're only allowed to do one or the other on your tax return. So if you take money out of the 529 and use those tuition expense, like the qualified expenses to take the money out, then you couldn't also claim the credit on your tax return. If you wanted to just pay something personally, you don't feel like you're going to qualify for the credits, there's nothing wrong with that, but it doesn't really fall into either one. It wouldn't fall under a tax-free withdrawal, and it wouldn't fall under the American Opportunity or Lifetime Learning Credits unless you don't have a 520. Like if you're just funding it off, as you go without the 529 benefit, then you could use just personal funds, family loans and stuff like that.
Mm-hmm. Perfect. If I need to choose between the American Opportunity Credit and Lifetime Learning Credit, which one should I choose?
Well, the biggest opportunity and the biggest credit available is, of course, the American Opportunity Credit. If that's available and you're choosing between the two, you would always choose the American Opportunity Credit just because it has, some better flexibility, higher limits. There's a portion of that that's also refundable. That means you can get, even if you don't have a tax liability that to offset it, you can get that refundable credit on the American Opportunity Credit. The Lifetime Learning Credit lasts a longer period of time, and it does have good uses. But if you have the ability to choose between the two, you always choose the American Opportunity Credit.
What happens if actually we already talked about that one. What happens if my child gets a scholarship? You mentioned that would reduce the amount you're spending. What happens if my child doesn't go to college?
With the 529 plan, if your child doesn't go to college and you have a 529 plan, there's a lot of opportunities there. You can fund an IRA for them with the funds that's in the 529 plan. You can just withdraw it, but the problem with withdrawing it is that you are then taxed on the income that it's earned. So you'd want to be careful of that. If your child's going to go to a trade school or something like that, those are now covered under the some of the programs. They're also covered under the 529 plan. You can deduct withdraw money to pay for things like trade school. And sometimes, if you can just leave the account sit there for a little while, and if the child, can either change their mind or, choose a different path, that the funds could then be used for.
And I guess you kind of skipped over the easiest option. If you got another child, you can just change the beneficiary. So you went straight to.
It doesn't even have to be your child. It can be a niece. It can be, your cousin. It can be, pretty much anyone. You can just roll that over to another child that could benefit from it.
Okay, here's a good one. If I accidentally use the 529 funds for non-qualified expenses, what happens?
Well, there's no really like magic of what really is going to happen. If you take them out, you do have to claim them on your tax return, because you'll get a form from the government, 1099-K, that shows that withdrawal. And you do have to report on your tax return that you use those for education expenses. If you don't, then that becomes according to that ratio. If it's you hold out $5,000, you took out $5,000 and $3,000 of it was return of your money that you put in, but then the earnings are always taxable if you don't use them for qualified education expenses.
Okay, so basically that additional portion, it's not on the full amount you distribute, just on the earnings.
Right.
Okay, perfect. It looks like that's all the questions we got in the Q&A. So we're so glad you guys joined us today. If you guys are looking to have a discovery, if you're a business owner or you have more tax planning needs, accounting needs, we're happy to help you. Feel free to scan that QR code on the right-hand side. We can do a one-on-one consultation with you. If you're looking to just start on the taxes, feel free to email us at info@mullen.tax, or you can just call us at 281-440-6279. We'd love to hear any more of your questions, so shoot us an email. But thank you guys for joining us.
Thank you. Have a nice day.